Hello friends, welcome back to CMA Asan. I am Shamli Subramanian, and now we have SFM paper 14 on that study note 1, investment decisions, project planning and control. See what this chapter speaks all about. If you are planning to start a business, what are all the decisions you will take? What are all the plans you will make? Investment decisions, project planning and control. You need some kind of capital, some amount of labor, some amount of employees, some financial experts to plan your budget. These are all the decisions you will have to make while planning a business. This is the chapter which speaks all about investment decisions, project planning and control. What are all the investment decisions you will make? Whether to purchase this product or not, whether to make a project or not, whether to buy this product or whether to manufacture this product on your own. How can you control this project? How will you plan this project? So these are all the things this chapter speaks all about. So we'll need to study in this chapter. Estimation of project cash flows. First and foremost concept, we need to study about cash flows. Okay, what is this thing called cash flows? Initial cash outflow. See, if you are planning to produce a product, if you are planning to manufacture a product, you need some kind of investment. For that, you need to invest some amount, which is a cash outflow for you, but actually an investment for the business. I am repeating it again. It is an investment for the business, but actually a kind of outflow for you. So first we write it as initial cash outflow. So the first and foremost one, cost of the new asset. So it is an investment for you and it is an investment for the business and is an outflow for you. It includes transportation and other incidental costs related to the asset. See, if you install an AC in your home, you will have installation charges, you will have delivery boy charges, you will add all those costs into that AC and sum it up as a cost of the AC. So cost of the new asset will be all the costs which is incurred till the installation, till the asset comes into existence. So cost of the new asset will include all the transportation and other incidental cost. Next, plus or minus changes in the working capital requirement. What is this working capital? It is a formula. Working capital is equal to current asset minus current liabilities. What is a current asset? Cash or bank. What is a current liability? Some petty creditors, which means plus or minus means current asset minus current liabilities, which is actually the amount of creditors you have paid with your cash you have till now, you have right now. So what is the working capital? You will have to pay some creditors with the cash you have right now. So working capital, if it is positive, then you will have more cash than the creditors. If it is negative, then your creditors will be more than the cash you have right now. Okay, so changes in the working capital requirement, this need to be sorted off. Next, salvage value of the old asset. See, if you have already an asset which needs to be replaced and the amount you will have with the kind of replacement will be negative figure in this case, because we are talking about outflow. So if you have any salvage value which is an inflow for you, but as we are talking about cash outflow, we'll need to figure this as a negative figure. Okay, salvage value of the old asset. Next thing, tax saving for loss on the sale of asset. See, if you are selling an asset, for that WDV value is say 1000 and you sell it for 900. So 100 is a loss for you. You have to pay tax for the profit on sale of the asset, but if you have any loss which will have considerably impact your profit, considerably lesser your profit with the amount of 100, which means I'm writing a mock P&L here. P&L, here you will have all the expenses, here you will have all the revenues. Okay, profits and losses account. So if you have any amount of profit, say 1000, you will have to pay tax on this 1000, but you have any loss on the sale of asset, you will knock it off here. 1000 minus 100, which considerably comes to 900. So you will have to pay tax on this 900 alone, which means this loss considerably lesser the profit you already have with an amount equal to 100. So which is the tax saving? Any loss on the sale of asset is a tax saving for you. Tax savings are considered as an income for you. As we are talking about outflow, we write it as a negative figure. Tax savings for loss on the sale of asset. Likewise, if there is any profit on sale of asset which is a outflow for you, so we write it as a positive figure. Okay, cost of the new asset, let's sum it up. Cost of the new asset plus or minus changes in the working capital requirement minus salvage value of the old asset minus tax savings for loss on the sale of asset plus tax payable for profit on the sale of asset. Okay, if the block ceases to exist due to sale of old asset, which means a capital gain, if you read it in the capital gains chapter, if any block ceases to exist due to sale of the old asset, it will be considered as a capital gains. It will I think it is a short term capital gain, so you have to pay tax on that capital gain part. If any loss on the sale of asset, it is a tax saving, and if it is a profit, it is a tax payment, payable amount. Okay, so these are all the things we have studied in the initial cash outflow. There is also subsequent cash outflow and terminal cash outflow. We'll see it later. Net cash inflow after taxes. This is the kind of formula we need to memorize. Cash flow after tax. Net sales revenue minus cost of goods sold. What is this cost of goods sold? The amount of cost you have spent for selling the goods minus general expenses. These are all the general expenses other than interest. Interest means if you have any loan, if you purchase the asset with the help of loan, you will have some interest. So this includes, this general expense excludes this interest part minus depreciation. Then you will have profit before interest and taxes minus taxes. You will have profit after tax. So this part also excluding interest. If you add depreciation to this part, you will have net cash inflow after taxes. This we need to find out from every sum to determine whether this project is acceptable or not. We have another method for this formula, profit after tax, which is after charging interest, which means profit after tax, this includes interest, which means this part already have interest, but if we arrive the profit after tax after charging interest, then we need to add depreciation, add the interest net of taxes, that is total interest minus tax on this interest. Then we have net cash inflow after taxes. Okay, we'll understand with the help of a sum. They have given net sales revenue 10 lakhs, cost of goods sold 5 lakh, operating expenses 2 lakh, depreciation 1 lakh. If we less all these amount from 10 lakhs, we will have 2 lakhs profit, which is profit before interest and taxes. Then again, if we'll deduct interest from this, we will have profit before tax, and on that, if we less 30% of tax, then we will have profit after tax of rupees 1,05,000. So find the cash flow after tax in both ways, which means this way and this way. Okay, first we will have net sales revenue. These and all will have profit before interest and tax. From this we will take the answer 2 lakhs minus tax. So I compute tax of 30% from 2 lakhs. So 2 lakhs into 30%, which comes to 60,000. So if we less 60,000 from 2 lakhs, we will have 1,40,000. On that, if we add depreciation to this part 1 lakh, then we will have cash flow after tax of 2,40,000. This is one way of computing it. And we have another method, profit after tax after charging interest, which is 1,05,000. Profit after tax 1,05,000 after charging interest, which means 1,05,000, and if we add depreciation and interest, and which is net of taxes. What is the interest amount actually? what is the interest amount? 50,000, and net of tax means 50,000 minus 30% of tax. Minus 30% of tax, which comes to 35,000. So if we add all these together, 1,05,000, 1,00,000 and 35,000, it came to 2,40,000, which is both in same ways. Okay, this is cash flow after tax, net cash inflow after tax. So we'll end this class here. Relevant cost analysis we'll take up in the next class. Okay, bye.